And it's very hard to earn a lot as an investor when the business you're in doesn't earn very much money. Now some people do it. In fact, I've got a friend, Walter Schloss, who worked with Graham at the same time I did. And it was the first way I went at stocks, to buy stocks selling way below working capital. Very cheap quantitative stocks. I call it the cigar butt approach to investing. Is that you walk down the street and you look around for a cigar butt someplace. And you see one and it's soggy and kind of repulsive. But there's one puff left in it. So you pick it up and the puff is free. I mean, it's a cigar butt stock. I mean, you get one free puff out of it and then you throw it away and you walk down the street and try and find another one. I mean, it's not elegant. But it works. You know, if you're looking for a free puff, it works. Those are low return businesses. But time is the friend of the wonderful business. It's the enemy of the lousy business. If you're in a lousy business for a long time, you're going to get a lousy result, even if you buy it cheap. If you're in a wonderful business for a long time, even if you pay a little too much going in, you're going to get a wonderful result if you stay in a long time.
But then, and even though there are some aspects of Ben Graham in The Intelligent Investor that allude to the qualitative, Ben Graham was mostly about numbers. Buffett introduced the qualitative in a major way, looking for businesses with a sustainable competitive advantage, what Buffett calls a moat. Now, that's something that requires the exercise of judgment, much more than the Ben Graham approach. And of course, I, for one, am not as smart as Warren Buffett, so the odds that I will err in my judgment are much greater than the odds that he will himself. So the Buffett approach has to be handled, very carefully.
Value investing is a big tent, which accommodates many different people. At one end of the tent, there is Ben Graham, the founder of the value school in the 1930s, whose book, The Intelligent Investor, published in 1949, has been characterized by Buffett himself as the best book about investing ever written. And then at the other end of the tent, there is Warren Buffett himself, who was a student of Graham, worked with Graham for a while, then went out and on his own and made substantial and successful adjustments to the teaching of Ben Graham. So there is the deep value school, which is Graham, that's right. And then there is the Buffett school, which is introduced the qualitative in a major way. What I mean by that is he was looking for businesses with a sustainable competitive advantage, businesses that were likely to be as successful 10 years down the road as they were today.
So not only price, but in addition, a quality business that had a sustainable business.
And indeed, Buffett once said he would rather own a comfortable business at a questionable price rather than a questionable business at a comfortable price, which is completely opposite to what Ben Graham was saying. The poor man must have been turned over in his grave.
Now, you said that you've kind of floated between the two, the deep value of Ben Graham and the more quantitative value of Warren Buffett, but that Warren Buffett was more time-consuming, but possibly more rewarding.
That's right. I got lucky in the sense that when I took over in 1979, as a result of the 70s having been a decade that was difficult for equities, not just in the US but throughout the world, there were plenty of, and at a time when we were small, so we could buy small cap stocks, there were plenty of, both in the US and outside the US, plenty of Ben Graham type stocks, deep value stocks. And that's what we bought initially. And then, particularly since I worked alone between 79 and 86. And then as I staffed up, hired a few analysts, we moved more towards the Buffett approach, which, as you said, is more time-consuming, but potentially much more rewarding.
And why is it more time-consuming?
Because you really have to look at the business and try to figure out what the 4, 5, or 6 major characteristics, both strengths and weaknesses, of the business are. Because after all, Buffett himself said he was looking for businesses that had a moat around them. And that's more time-consuming than the Graham approach, which is to some extent, often it starts from the balance sheet. And he works out an adjusted net book value, and then he comes up with a net adjusted book value of 50. The stock is at 30. He buys it at 30. He's very patient. He sits on it, and as the stock moves to 40, 45, at 45 he starts selling. At 50 he's gone. And Buffett, years after Ben Graham passed away, called it the cigar butt approach.
Explain what that means.
Meaning that there is the move from 30 to 45 or 50, which is one good puff,
right,
and then it's all over. If you look at Buffett, he almost never sells. There are tax advantages, incidentally, to the fact that he never sells. He doesn't pay the capital gains tax.
Right.
But also because he has come across successfully a great number of businesses with sustainable competitive advantage. And a key question, if one adopts more or less the Buffett approach, is if the stock moves to what you think is the intrinsic value of the business, does one sell it automatically? And some value investors say, yes, you have to sell because it's fairly valued now. My point is, if it's modestly overvalued or moderately overvalued, and if you think you have a business that's really compounding, that creates value successfully over the years, you're probably better off holding on to it. And accept the fact that maybe for a while the stock does not go up, the profits have to catch up with the price of the stock. But to some extent, businesses that continue to be successful over the years are rare. You look at particularly now that you have the internet as a disrupting force.
Right.
Howard, Seth Klarman, who was one of the earlier presenters and whom you interviewed, has a book that the title which Jeff implicitly referred to.
Yeah.
Is your view that value investing as a category has A, gone out of style, and B, is it riskier or safer than growth investing?
No, I think that value investing is, first of all, the distinction is a little bit artificial, and it's not. And anyway, it's certainly not black-white. Value investing means making investments based on the current characteristics and attributes and assets and values of the company. And growth investing means investing primarily on the basis of the potential and what it might look like 10 years from now, 5 years from now, 20 years from now. Clearly, it is, everything else being equal, it's less risky to invest on the basis of things that exist today than on the basis of things that might exist in 10 years. There's no question about that. However, I say it's not that clear-cut because the value of the things that exist today is largely attributable to what they'll produce, especially in terms of cash flow, over the next X years. So you can't divorce yourself from thinking about the future. So people say, well, value investing is about the present and growth investing about the future. But you can't divest yourself of thinking about the future because let's say you want to buy a factory that makes XYZ. You don't buy it for the bricks and the steel and the real estate. You buy it for its ability to produce a product that makes money. So there have to be some judgments about the future irregardless. The question really is the relative weighting. So you buy, look, back in the 99 period, people bought stocks of companies that had an idea, no product, no clients, no revenues, no profits. That was an extreme case, and most of those worked out very badly. But clearly, the people who invested in eBay or Facebook or some of these have made a lot of money, and now one of my favorite quote from a fortune cookie. I actually found a fortune cookie one time that said, the cautious seldom err or write great poetry. and so, for the most part, the value investor thinks of himself as not erring so much, and the growth investor as writing great poetry.
Okay. So Seth got the title right in some sense.
Yeah, I think that's right.
Okay.
I'd like to know, would you rather buy outstanding companies at fair prices or fair companies at outstanding prices?
That's a good question. And I don't think I'd like to buy good companies at what I think they're worth. I really I have no problem buying a good company, but I want it at a discount. I'm looking to make a profit, and I don't want to lose money. And if you can, at times, once in a while, people get very nervous, and you can buy a good company at a fair price. I don't really I can't generalize because each company is different. But if you want to make a profit, you really want to buy a stock at a price that you think it'll go up, say 50%. Now, it may take several years for that stock to go up, and then you just have to be patient. Now, one day, this goes back to about 1951, you weren't around and so forth, but a fellow came to me and he said, the company that we're interested in, that one of the, I can't even remember the name of it, it was a company that analyzed other companies, and he said this particular company said that there's a method there where they can copying machines, and the Battelle Institute in New York, I think it's in New York State, has said this company has great possibilities. Stock was selling, it was selling at about 20, and it had gone through the Depression. It was listed on the exchange. It was a small company. And I went into Mr. Graham and I said, this company's got a new product, a copying machine. And he said, well, Walter, we don't really buy stocks like that. Well, of course, it was Xerox, and it went up a great deal. And the only consolation I had was that it had gone from 20, where we saw it, had gone to 50, they would have been out of it. And the fact that it went up to 1,000 to 2,000 after splits, I wouldn't have bought it. I bought it only because historically there seemed to be an interesting stock, but he was right that it really, you didn't know that this particular product was going to be such a success. The only thing you could say was the Battelle Institute said that it was good.
Charlie, you're largely credited with Warren Buffett's evolution to buying great businesses at a reasonable price, or in simple terms, a willingness to pay up for a great business. Given Ben Graham's exceptional insights and understanding of investing, how or why did he himself not evolve to foresee the inability to scale his net cigar butt approach? What do you attribute your early willingness to pay up stems from?
Remember, a lot of Ben Graham's rise in life was during a period when there was plenty of low-hanging fruit among mediocre businesses that were way too cheap. And he was relatively rare in doing his hunting in that garden. And so he made a pretty good living for himself buying these. What happened is that low-hanging fruit eventually went away as the aftermath of the Great Depression went away. And Ben Graham actually made more than half of all the money he made in his life out of one stock. And that stock was Geico, which was a great business. So if you actually look at the great man's own life, you see that what he taught wasn't the way he got rich himself. And by the way, he told that story on himself late in life. He carefully computed how much he'd made in Geico compared to everything he had ever done in his previous life. And so you can argue that Ben Graham himself woke up once.
Why do you think that you, so early on, were willing to come up with this idea of paying up for great businesses?
Well, because it's so obvious, and I'm good at doing things that are obvious. Of course, it was obvious if you wanted to have a particularly good result, you got to do a great company. You know, I recognized that greatness was good. You know, big deal. Charlie Munger, genius, recognizes greatness is good. Of course, greatness is good. Well, it helps to have somebody that's lucked into a good position. So a great business would be what you'd like, and of course you'd like a great management too. And occasionally we've had both to ride together for a long, long period. But of course, everybody's looking for the same thing. And the trouble with it is you will find when you get into those good businesses, places picked over and analyzed as American stocks are. And you can imagine the amount of time spent thinking about American stocks. And you will find, by and large in America, if it's really a great business, it's at least 25 times earnings and maybe 30 or 35 or something. So that makes it much harder, of course, because if something goes wrong, you can lose a lot of your investment. And of course, that's what makes investment so difficult, is the fact that the good businesses don't stay cheap. You got to somehow recognize a good business before it's recognizable as a good business. That's very hard to do. Some people get good at it, but not many. I don't think I would want 95% of the people who are America's professional asset managers, I wouldn't want working for me.
Really?
I think it's that hard. I think you need to be in the top 5% to have a reasonable chance. It's very difficult. Now, it's not difficult to just buy an index fund and sit on your ass. That's the great default position.
These are all.
Well, I would say some of the things that surprised me the most was how much dies. The business world is very much like the physical world, where all the animals die in the course of improving all the species so they can live in niches and so forth. All the animals die, and eventually all the species die. That's the system. And when I was young, I didn't realize that that same system applied to what happens in capitalism to all the businesses. They're all on their way to dying is the answer, so that other things can replace them and live. And it causes some remarkable deaths. Imagine having Kodak die. It was one of the great trademarks of the world. There was nobody that didn't use film. They dominated film. They knew more about the chemistry of film than anybody else on earth. And of course, the whole damn business went to zero. And look at Xerox as once owned the world. It's just a pale shrink. It's just nothing compared to what it once was. So practically everything dies if you on a big enough time scale. When I was young enough, that was just as obvious then. I didn't see it for a while. Things that looked eternal and had been around for a long time, I thought wouldn't likely be that way when I was old. But a lot of them have disappeared. Practically everything dies in business. None of the eminence lasts forever. Think of all the great department stores. Think of how long they were the most important thing in their little community. They were way ahead of everybody in furnishing credit, convenience in all seasons, convenience back and forth, use the same banks of elevators and so forth, multiple floors. It looked like they were eternal. And they're basically all dying or dead. And so that once I understood that better, I think it made me a better investor, I think.
I mean, the same can be said for managers. I've talked with Doug McMillon of Walmart, who carries around in his wallet, like on him, he carries around a list of the top retailers over the decades, and nobody's ever the same. You know, you get
yes, who are gone. Yes, yes. Of course, retailers live in terror because you can die. Some guy gets a better way of doing it, and you just die, like those department stores did.
The ones that you invested in early on, you mean? Is it Baltimore?
Well, no, most of think of the department stores that are gone, just chain after chain after chain in big downtown. They're not weakened, they're gone, dead. And to have IBM have the huge position it once had in terms of utter dominance, and now it's just one of the also-rans. And it's still an admirable place. I'm sure they have a lot of talent left in IBM. It doesn't help you. You die even though you're talented and hardworking.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.